This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So we're going to go through now and look at your diluted earnings per share. And diluted earnings per share takes account of any potential future changes to share capital as a result of any instruments that are in issue at the end of the year, to help show the shareholders that, look, in the future your earnings per share may get lower because we issue more shares. Okay, so what we've got, there are two types of items in issue at the end of the year that could give rise to dilution of your EPS, and they are convertible debentures and share options. We'll deal with each one in isolation and then we'll work our way through the example. But if you think about convertible debentures, what happens with convertible debentures is at some point in the future, the debenture holders will convert for shares. So if that's the case, the number of shares are going to go up, aren't they? Okay, so we'll need to take account of the biggest potential increase that there could be in the number of shares that are issued in the future. That's the key bit. It needs to be the largest number of shares. Okay. However, don't forget as well that when those debentures are converted into shares, there's no longer any requirement for the company to pay interest. So if we no longer pay interest, then our profits are going to go up. But if our profits go up, then we will also be taxed. So there'll also be some tax on that extra profit. So the extra profit that we will generate in the future is the interest saving, but we will also have tax to pay on that interest. So it will be the post-tax interest saving. Okay. If we go through there and look at your share options, share options are whereby your employees have the option to convert to shares at some point in the future, don't they? And based upon that, then what we have is there will be more shares in issue in the future. But don't forget that the shareholders will pay for those shares, but will pay for them at a discount to the market value to make it attractive to your employees to take those shares. So there is, if you like, cash received in the future, which will increase the earnings. So we don't know by how much the earnings will increase, but we'll assume that the increase in earnings will be offset by the increase in number of shares. But we need to be careful, because what happens there is, because we are issuing the shares to our employees at a discount, there is a free element, isn't there, of shares. And if there's any free element, then we need to take account of that free element of the shares. How does that come about? Well, the way I like to think about it is, when I was younger and I used to go and buy CDs and DVDs from the local shops, there always used to be offers on. And the offer was always buy buy 3 DVDs for £20. Okay, which, you know, thought, right, that sounds like a pretty good deal, doesn't it? Yeah, for £20, I'm going to get myself 3 CDs or 3 DVDs. Which, when you think about it, the price of a CD normally is just about £10, isn't it? So it's saying, look, if you spend £20, you're essentially buying 2 DVDs at full price, aren't we? But you are getting 3 for that £20. So it's like saying, buy 2 and you get 1 free. Okay. So what we're going to do there is to work out the free element of the shares. We're going to look at how many shares we will get if we paid the full market value, compared to the number of shares that we get under the offer that is made. So if we look at the CDs, the offer that was made was get 3 CDs, but if there was no offer, you'd only be able to buy 2. So the difference between the 3 and the 2 is the number of free CDs, which we will then think about it from a share perspective. We will go through there and look at the number of CDs you get under the share option scheme compared to the number of shares you could get without entering into the option. Okay, so we'll come back and recap that when we look at share options. But let's go through there and look at the convertible debentures to work out the basic EPS and then the diluted EPS. So the number of shares is 1 million or 1,000 million. Earnings are there, is it at 500 million? So if that's the case, then as things stand, is that my basic EPS is there, is it as your $500 million divided by 1,000 million shares, which works out at 50 cents per share, doesn't it? Excellent. What we then need to go through and do is ask ourselves, is that diluted? Is it going to be reduced by any potential future share issues? So what we need to go through and do there is to the 1,000 million, we need to add on the maximum potential number of shares under the debentures. And we also need to go through there on the earnings, add on your interest saving, but remember that interest saving needs to be post-tax, because as we save the interest, it pushes the profit up, and as we push the profit up, we pay tax, don't we? So what have we got? Well, to go through that and work out your interest saving, what have we got? We have in issue, is it 10 million 5% convertible loan stock? Okay. So if that's the case, the coupon rate is 5%. The loan stock is there, is it as 10 million? And if we go through that and look at the tax rate is there, is it as 20%? So to get the post-tax figure, you multiply by 1 less, is it the 0.2? So if you tap that into your calculator, I think you end up, is it with $400,000? Okay. If you're putting that into millions, is that $0.4 million? There we go. Everybody happy with that? Okay, yeah. The post-tax is like what we saw when we looked at our discount rates for the cost of debt. Everything was post-tax, so it was 1 less the tax rate, wasn't it, on the interest? What we also need to go through and do there is look at the maximum number of shares that could be issued, because here you have different conversion dates and different conversion terms. Here the maximum will be the 125 shares for every $100 worth of loan stock. So if that's the case, I have, is it $10 million worth? So was it for every $100 I get 125 shares? Tapping that into your calculator, I think it gives me 12.5 million extra shares as the worst case scenario. Okay, we're always looking at the worst case scenarios, aren't we? If you like thinking about that world of prudence. So to go through that and then to work out your diluted EPS. Your diluted EPS takes your original earnings, is it, of 500 million, adds on 0.4 million. The original number of shares in issue was 1,000 million, to which we add on 12.5 million. Tap that in on your calculator. You should get, I think, is it 49.4 cents per share? Okay. Which is less than the original 50, so therefore it is diluted. Okay. You can always work out to see whether or not it is dilutive in nature by doing the 0.4 divided by 12.5, and if that is less than, is it the 0.5, then it will always be diluted. Okay, the reason less than 0.5 because that was your original basic EPS. Excellent. So that's looking at the debentures. If we go through there and look at the share options, again, what you've got is a basic EPS of 50 cents per share. We need to go through there under the share options. There's never any impact on earnings. We just need to look at the number of free shares given under the option. Okay. So what you've got is it says Flanagan granted 100 million options. So the number of options that we get under the scheme is 100 million. However, the option price is 2.5 and the average fair value is $4. So we need to use the $2.50 and the $4 to work out how many shares we will get at full market value. So we've got a little bit of a pro forma. If we learn the pro forma, you'll have no problems in the exam. So you look at the number of shares under the option, which goes through there. If memory serves me right, that was there, wasn't it, as 100 million. Okay. If I pay the $2.50, I get 100 million shares. I then compare that to the number of shares that I would get at market value. And the difference between the two is the free number of shares. That's like we said before with the CDs, isn't it? Under the offer of buy 3 for £20, you got 3 DVDs under the option. But if you went in there with £20 and there was no offer, you could buy 2 for $10 or £10 each. So 3 to 2 is essentially you getting 1 free, aren't we? So to work out the number of shares at market value, well, we get 100 million under the offer. So to do that, I would have to pay $2.50 for each one. So $2.50 multiplied by the 100 million will give you your full amount of cash that you have available to buy the shares. If we divide that by the market value of 4, then that will go through there, won't it? And give you the number of shares that you could actually buy using your funds at $4 per share. If you tap that into your calculator, is that 62.5 million, which gives me $37.5 million. Okay. Oh, sorry, not dollars, free shares. So that's 37.5 million free shares you are getting under this option. So if that's the case, to go through there and work out my diluted EPS, we take your original earnings, which was 500 million. The original number of shares were 1,000 million. And you add on, is it the free shares that we got at 37.5 million. Tapping that onto your magic calculator gives you 48.2 cents per share. Share options will always be dilutive in nature. It will always reduce your earnings per share. It has to, because you're not changing the earnings at the top, but on the bottom you are increasing those shares, aren't we? So it has to reduce your earnings per share. And when you're working it under share options, it's the number of free shares that you add on at the bottom, and to work it out you have that formula or that pro forma. So therefore I would ensure that you learn the pro forma. So it's the number under the option compared to the number at the market value. There's an easy way to remember how to work out the number of shares at the market value. You just take the number of shares under the option and multiply by the smaller divided by the larger share price. Okay, if you do that, you're not going to go too far wrong. Objective test questions could ask you anything. It wouldn't combine share options and debentures. It would do them separately. It could ask you to work out the diluted EPS under one or the other, or it might even just ask you to work out the number of free shares. It might just ask you to work out the post-tax interest saving with regards to your debentures, or it may just ask you to go through and work out the number of shares to be issued in the future under convertible debentures. So that there's plenty of flexibility with regards to question style under the objective test questions. The only way to get good at that flexibility is to be flexible yourself and keep practicing those questions. So let's go through and finish off the chapter on earnings per share by just looking at the limitations. Again, I think it's just things to bear in mind. It could be one of those type of select all questions asking you which of the following are or are not limitations of earnings per share. Okay, so have a read through the page, make sure you're happy with it. We'll just add bits and pieces as we go along. First limitation is that it is historic. It's a great performance indicator, isn't it? Because it does, as we saw at the very start, give you a better idea of how a company has performed during the year with the funds that it has available. However, it's all based on the past, isn't it? You know, that's one of the downsides of financial accounting. It looks backwards, doesn't it? At least with management accounting, that looks forward, doesn't it? So if we're trying to think about future performance, earnings per share doesn't really help us, does it? Okay. Likewise, there's a limitation with regards to, it says the share price, so that's thinking there around this price earnings ratio. As we've seen within our financial analysis, so the ratios, the price earnings ratio is a good indicator, isn't it, about the success or what the shareholders believe the future success of a business will be. The higher the price earnings ratio, the more that means that a shareholder will be prepared to get that year's earnings, and therefore the higher they will pay must mean that they are confident in the future performance. You wouldn't pay more, would you, if you weren't confident about the future performance? So the issue that you have here is that your earnings per share will be calculated every year. Okay, how often does a share price change during the year? Quite a lot. It changes on a daily basis, doesn't it? You'd hope that the fluctuations shouldn't be too big, but you know, there's going to be circumstances beyond the control of the business that will cause large changes within the share price. So the issue that you've got there is that the share price is an up-to-date figure, but the earnings is a historic figure. And if you've got an up-to-date price figure on the top and a historic earnings figure on the bottom, then that just sort of makes the price earnings ratio maybe that little bit less meaningful. Okay, it would be nice, wouldn't it, to have an up-to-date price with an up-to-date EPS figure, but only really happens at the end of the year. The other figure that you've got there is that we're looking at earnings, aren't we? Earnings is post-tax. Okay. And what you've got there is if you're comparing the earnings per share of one entity to the earnings per share of another entity, if they're in the same jurisdiction, so if they're both in the UK, then the tax rules are going to be the same for company A and company B, aren't they? So you can compare like for like. But if we compare company A to company C, and company C is in any other country other than the UK, so let's just go through there and say America, then the tax rules will be different. Okay, therefore, if you have different tax rules, you will have different post-tax earnings, and therefore that makes things that little bit less comparable. We're not saying they're totally not comparable. It depends upon the differences in the tax rules and how significant they are, but it is a limitation, isn't it? Again, the other issue that you have about your earnings is that there could be a choice of accounting treatments, couldn't there? What happens there if one company adopts the revaluation model and another company adopts the historic cost model for valuing property, plant and equipment? I hear you say, so what? Well, under the revaluation model, your depreciation will be higher. And if your depreciation is higher, then your earnings will be lower. So if you're comparing the historic cost company to the revaluation model company, then your earnings per share under the revaluation model will possibly be lower, as we've got a higher depreciation charge. Okay, so again, a little bit less comparability. The other one as well, I suppose you could think about without going too far, is looking at your financial instruments. So you've got your assets that are held at fair value with gains and losses through profit or loss. You've got your assets that are held at fair value with gains and losses to OCI. You know, what happens if one company classifies something as fair value through profit or loss? What happens if the other one compares it to fair value with gains and losses through OCI? You know, one company is going to have much higher or lower profits depending upon the changes in the value of the financial asset, whereby the other entity, the changes in the value of the asset don't impact the profits because the gains or losses are hidden away, aren't they, in OCI? Okay. The last one is looking at the accounting standards. Not talking about choices of accounting standards, but more the fact that, again, if you're comparing across borders, one company to another. You know, we had company A and company C. Company A was in the UK and probably prepares its accounts under IFRS. Maybe the American company prepares it under local American rules. If there are differences within the rules, there will be differences in the reported profits. And if there are differences in the way the profits are reported, that again reduces the comparability of your earnings per share figure. So there's 6 limitations to go through and learn. If you learn them, then you'll be really happy if a question comes up on the limitations of earnings per share.